Are you being denied for credit cards, business loans? Maybe you're looking to get funding to grow your business. Maybe you're looking to move to a new place, right? Get an apartment, get a new house, right? Maybe you're looking to invest in real estate. Maybe you're just looking to get a new car. Maybe you're looking to start trucking, so you need an auto loan. Whatever the case may be, maybe you're looking to get something that involves your credit, but you're getting denied. In this video, we're going to talk about 5 hidden truths that most people never realize when it comes to building their credit scores to a 700, 800 plus score. By the end of this video, you're going to know how to get your credit score to a 700, 800 plus in 2026. All right, so make sure you tap in.
Fat Daddy, baby.
Rich Rising, y'all. It's your boy, the Real Fat Danny. In this wealth conversation, we're going to talk about 5 hidden truths that most people don't know when it comes to building their credit score to an 800 plus. And if you don't know, we've been helping people fix and build their credit since 2021. So we've helped hundreds of people fix and build their credit, access personal and business funding, for their businesses. And I've been a full-time entrepreneur since I was 22 years old. So I'm very grateful to be in this position to share with you guys how you guys can focus on different strategies to build your credit score this year. And if you want some help, if you want some personalized guidance, get access to my community or my credit restoration service where we can do it for you. And either way, we're going to get you right. All right, but for no cost in this video for free, I'm about to give you guys some game on what you need to focus on when it comes to building your credit score. All right, so let's go. Here we go. Number 1, utilization timing is way more important than most people realize. Most people think that just paying their cards by the due date is the best thing to do and that their score will be fine after that. But that's not the case, because the credit reporting agencies do not see the balance on your credit cards every single day. So when you make a payment and it's by the due date, that doesn't mean that the credit bureaus see it on that very day. What happens is you need to check the statement date on your bank balance sheet, on your bank statement. And on that bank statement, it will show you when it's actually being reported to the credit bureaus. This is the statement date, because the statement date is what actually matters. The statement date is what the credit bureaus will see for your utilization. And from that point on, for the next 30 days, that's what's going to stay on that credit report until it updates again. So it's important to understand, yes, you do need to make your payments by the due date, but you cannot go ahead and use up all the utilization on the card before the statement date. Let's say your due date is on the 14th, but the statement date is the 17th. If you make your full payment by the 14th, but you utilize 100% of the card by the next day, then when it reports to the credit bureaus, right, to the credit reporting agencies on that statement date, right, on the 17th, they're going to say, hey, you used up 100% of this, and this is what we're reporting. So that's where a lot of people get mixed up at, is they think that when they make the payment for their due date, that also is going to reflect on their credit report. That's not always the case. You have to pay attention to your due date, make your payment by your due date, but make sure you also keep that utilization where it is by the statement date, and then you can utilize it however you need to before the next due date and statement date. Ideally, you want to keep your credit card utilization below 10%. So if you have a $10,000 credit card, you want to keep it below $1,000 by the time it reports to the statement date. If you want to have superior credit and an even better credit score, because we're talking about getting to 800 plus, right? Then you want to actually have a 1 to 3% utilization on that card. So if you have a $10,000 card, you only want $100 to $300 reporting by the time that statement date comes around. And the reason why you don't want to pay it all the way down to 0 by the time the statement date comes around is because you don't want it to seem like you're not utilizing the card. The algorithm and the system wants to see that you're actually utilizing the card, including the banks. Sometimes banks will even shut down your card if you're not using it at all, right? And if it appears that you're not utilizing your card, then it's not really good for your credit score, and it's not good for the relationship with you in that bank. So you do want to utilize the card, but keep it below, 1 to 3% if possible, and just leave a couple dollars on there when the statement then comes around, so that way they can see that you have been using the card. Number 2, credit age is a silent wealth indicator. You see, when banks pull your credit report, they're looking to see how credit worthy you are. See, we have partnerships with many different banking managers at different banks, many different national and local banks around the United States. And they tell us exactly what they're looking for on credit reports when they're looking to approve people for funding, when it comes to high limits, 0% interest funding, and so on and so forth. They're looking for certain indicators on your credit report, certain data points, as we like to call it in the industry. Now, your credit age is one of those data points. If you have a fresh credit age and it's green and it's, a fresh baby out the diaper credit, right? And it only has 1 year, 2 years of age on there, they're going to see you as more of an amateur, consumer when it comes to credit. But if you have 5, 6, 7, 10 plus years as credit age on your credit report, then that's actually going to allow you to seem like much more of an expert when it comes to your credit utilization, because they like to give funding to people who utilize their cards and utilize their credit responsibly, who are making their payments on time, who have relationships with other banks for years. Not that you just got approved for a credit card last month, but they want to see that you've had credit age for years, right? So this will help you boost your credit score a lot more, and not only your credit score, but it'll boost your credit worthiness to different lenders and underwriters when they're looking to approve you for funding. See, a lot of people make mistakes when they close old accounts or when they close credit cards that they're not really using, because that doesn't help your credit score. If you have old credit cards or old accounts and stuff like that, do not close the credit card. Do not close the account. Just keep it up, because that age will actually help your credit score over time. I feel so bad when I hear different clients that we've had come, to us and tell us like, oh, I've had this account for like 10 years, but then I shut it down because I wasn't really using it. And I'm like, that's one of the worst things, unfortunately, you could have done, because at the end of the day, that 10 years of age was helping your credit score and helping your credit worthiness, so that when you're ready to get a loan, a mortgage, a credit card, they can see, oh, look, this person has 10 plus years of credit age on their credit report. So y'all, it is a silent key to wealth, because at the end of the day, when you have more credit age, the lenders see you as more reliable, then they can give you more funding, and you can do a lot more with more funding. Number 3, your credit mix is actually super important, because a lot of people don't realize this, but there's a big myth in different communities that, oh, you should only have 1 credit card or 2 credit cards, or, stay away from credit. If you can't afford it, don't buy it. And all of these things you need to stay away from, y'all. Even when it comes to things like, oh, if you can't afford it, don't buy it. I mean, literally businesses are created by leveraging funding and borrowing money from the banks, using that money to buy or invest in things that they couldn't afford with their own liquid cash, or maybe they could, but they didn't want to because they have leverage with the bank's money. And now they're able to make money with the money that they leveraged from the bank instead of using their own money. This is how the wealthy operate. And so the next thing you want to understand is that the credit mix of your profile is super important, because lenders are not just looking to see if you have 1 or 2 credit cards with a couple $1,000s on there. If you do, then that's great. It's a great start. But you want to understand that if you're looking to get high limit funding, 0% interest business credit cards, business loans, and large personal loans, and auto loans and mortgage, different stuff like that, you want to understand that there are different factors that they're looking for. They're not just looking at your score, y'all. The score is the preliminary determinant that they look at to see if you qualify or not. Once you pass their credit score check, they're looking at your profile to see the different accounts that you have on there. We talked about the age, right? But now they're looking at the different accounts that you have on there. So do you only have 1 or 2 credit cards? Do you have any installment accounts? Do you have any loans, mortgages, auto loans, personal loans, so on and so forth? So if you're someone that has a mortgage, for example, you need to get excited. All right, because when you have a mortgage on your credit profile, they like to see that. They see you as more credit worthy. They see you as someone that's handling a large account so you can handle large amounts. All right, get excited because they see that large mix on your profile. Maybe you have a mortgage, maybe you have a couple different credit cards, and then maybe you have an auto loan. Perfect mix because you're showing that you can handle large accounts and that you're also handling your revolving accounts. That's why the first thing we talked about was utilization, right? Because if your utilization is right, and then you have the different mix of profiles, and you have a large credit age or a large credit history, your score is looking better than it was before. I'm telling you right now. And once again, not only the score, but your chances of getting approved for higher limits and lower interest increases greatly when you have all these things put together. So getting to an 800 plus score is understanding that it's leveraging a mix of different accounts. You're showing to lenders that you are credit worthy and that you know how to handle risk. And the fact that you have a different various amount of accounts, different types of profiles, you've gotten approvals from different types of banks or institutions, and you're handling them properly, making your payments on time, keeping the utilization low, everything is going to work in your favor when it comes to these applications and when it comes to your credit score. You have to look at your credit report almost like your resume. You know, when we were in school, like K through 12, grade school, whatever you want to call it, our report card was how we were judged, right? So now as adults, hey, our credit report is how we're judged. And it's definitely how we're judged by the banks. And how you're judged by the banks can ultimately determine how well you have access to leverage. And how well you have access to leverage can ultimately determine your financial future. Because once you have access to good leverage, then you can really change the trajectory of your finances in a way that you never could if you don't have access to leverage. And leverage means funding. Leverage means being able to get approved for a loan, being able to get approved for credit cards, being able to get approved if you want to move to a new apartment or a new home, being able to get approved for a new car or a new vehicle so that way you can go from A to B, do the things you need to do, right? So these are the differences of having leverage and not having leverage, having good credit and not having good credit. And that's why we have to focus in 2026 and making sure that we get our credit straight, y'all. So make sure you're taking notes because we're about to get to the next one. Number 4, and this is a big one, y'all. Inquiries and new accounts can actually hurt your credit score more than you ever thought. And this is the catch-22 of credit. You guys have to understand, we have to understand that credit was not created just for everybody to just use, not pay back, and get over on banks. Credit actually started for businesses initially. So that way businesses could leverage capital, leverage resources, and pay things back as they made money on whatever they borrowed. But over time, it now leaked into personal consumerism, right? Where as an individual, you're now able to have credit. We have credit scores, but you have to leverage that, y'all. You have to understand that when these things were created, they put checks and balances in place. Okay, so when it comes to inquiries and new accounts, it's sort of crazy when you think about it. Let's say you do have an 800 credit score, but if you apply to 10 different banks within 7 days, I promise you, you will no longer have an 800 credit score. I guarantee you, you will definitely have gotten approved for, many of the different applications you put in. And, but at the end of the day, that score will go down because that's the checks and balances that they put in place. Because think about it like this. If we were all able to get to an 800 credit score, and technically when you first start with credit and you open up your first account or whatever the case may be, you're already dang near 700 plus because you don't have bad credit when you first start. Hopefully, right? Hopefully you don't get an account, you just mess it up the next day. But even when you start your credit fresh, you already start with a good score, right? So at the end of the day, if you were able to just apply for 50 banks, in 7 days, and your score was never affected, and you had an 800 score before the applications and an 800 score after, then technically we all would be able to just apply for funding every single day, everywhere, every month, without having our score go down. And they know people will go crazy. everybody would have over $500,000 in funding, because everybody would be getting approved and nothing would be happening to your score. And so that's the checks and balances, y'all. Because you apply for funding or application or whatever, it adds a hard inquiry to your personal credit report. Once that hard inquiry is added to your credit report, your score goes down no matter what. Now, when you get a new account added to your profile, the reason that your score goes down as well is because now it lowers your credit age and it adds a new account, a new profile to your credit. So all these things actually lower your score a little bit, because it sort of lowers the average of your total credit age history when you open a new account, because it's fresh, right? It has 0 months of credit age. So it lowers the average of all of your accounts when you put them together, if that makes sense, right? So inquiries and new accounts can definitely kill your momentum when it comes to building your credit. You do not want to be applying for stuff while you're focusing on building your credit. You want to do one thing at a time, y'all. When we're building our credit and we're fixing our credit and building it, we're fixing and building it. We're not applying for a bunch of different things. Now, I understand you might be, in a tough situation where you need to move or you really need to get some funding or whatever the case may be, but try to hold off as long as you can. And that's why it's important to start fixing your credit now if your credit isn't where it needs to be. I always tell people fixing your credit is like a time bomb. It's like a ticking time bomb. But if you don't start fixing your credit now, it's not ticking yet. So it's never going to blow up. Your credit score is never going to blow up because you never activated the time bomb by starting to work on your credit. Because check this out, no matter when you start working on your credit, it's going to take that amount of time. Some people, it takes 5 months to get their credit fixed. Some people, it takes 12 months to get their credit fixed. Some people, it takes 7 months. But each person is different. But whatever that number is for you, it's there. And so the longer you wait to start it, it doesn't shorten the process of how long it's going to take to get your credit fixed. So I always say focus on getting your credit fixed now. Start working on getting your credit fixed now, so that way you can focus on fixing and building your credit up. So that way when you need to apply for stuff, your score is built, the negative items are off your credit report, you've added the proper accounts, you had the different mixes, you lowered your utilization. Now you're ready to start applying for different things, so that way you put yourself in the best position before you start applying for any funding. Because like I said, while you're building your score, if you're applying for new accounts and you're applying and adding hard inquiries to your credit score, to your credit, then it's going to lower your credit score, y'all. So let's focus on fixing and building it up, and then we can start applying for things which will add the inquiries and stuff like that. Because remember, when we fix and build our credit, those inquiries will lower our credit score. But thankfully, we help our clients and our community members remove inquiries off their credit report, so we got the sauce for that as well. But anyway, let's move on to the next one. The last one I'm going to talk about here is that credit scores are more about perception. It has nothing to do with your income. You have to understand that. Now, when it comes to business funding applications and different stuff like that, when they're asking you for your income, stuff like that. I mean, of course, they want to understand where you're at income-wise, so they know that, if you're asking for $50,000, but you make $50,000 a year, it's probably not going to be the best outcome, right? So, of course, they're going to look for different things when you're applying for, let's say, funding, like business loans, business credit, stuff like that. But when it comes to getting a new apartment, getting a new house, different stuff like that, let's say for rental, many times with apartments, they're going to look for like 3 times your income, 3 times your monthly income, right? So let's say you're looking to get a spot that's $2,000 a month. Let's say you make $6,000 a month. Cool, right? But they're still going to look at that credit score. And your credit score has nothing to do with your income. Your credit score is comprised of all the different things that we talked about here today. What's the age of your credit report? How many accounts do you have, and what's the mix of your accounts? Another misconception in many communities is that you want to have a low limit of accounts. But technically, we like to say 17 is pristine, right? Technically, you can have 10 to 12 accounts and you'll be, pretty easy breezy. You'll be pretty cool, pretty good to go when it comes to getting approved. 8 plus is pretty good, but 17 is pristine, right? But if you only have 1, 2, 3 things on your credit report, don't expect a lot of abundance from that. I won't lie to you, right? Because they want to see, like I said, that you know how to manage different accounts, that you know how to manage different limits, that you know how to manage different types of accounts. So that's why it's important that you have at least 8 to 10 plus open positive accounts that are reporting to your profile, that are open, that you are not late on, and that you have low utilization every time the statement date rolls around. If you have all these things on your credit profile, then your credit score will be great. It doesn't matter if you make $40,000 a year. You can have an 800 plus credit score making $40,000 a year, get access to funding, invest in real estate, get funding to grow your business. We can show you how to grow your business online and create digital products and services and grow your social media, whatever the case may be. But now you can turn your position from being $40,000 a year to $40,000 a month, right? And we've helped people do it. And we have testimonials in my YouTube as well about it. But the reality is you can have a $40,000 a year income, and you can get an 800 plus credit score, get access to 100, 200,000 plus dollars in funding, and now you can completely change the trajectory of your life, your family's life, and your generations to come when it comes to your finances. While someone that makes $300,000 a year could have a 500 credit score, believe it or not, and they're not able to access any leverage. They're not able to move into the house they want to, get the car they want, get the funding they need, do the things that they want to do necessarily with their credit because their credit is bad. It's not about income. It's about how you are handling your credit. And there are different points that pertain to your credit report that make up your credit score. And in reality, those things do not necessarily have to do with your income, because you can use the income you have today, y'all, no matter what position you're at. I started off, when I was 18, 19 years old, I didn't even realize how important credit was until I was finishing my junior year and I was looking to start applying for apartments and I was getting denied. So I had to have my dad become a guarantor, y'all. I won't lie, y'all. I won't cap here on this video. I had bad credit too, but I had to get it fixed. I learned and invested in the education to learn how to fix my credit. And then I learned actually how to start a credit repair business, fix my credit, got myself funded, got my business funded, helped my family, helped some of my friends get funded. Then I turned it into a business, right? So at the end of the day, I learned the actual psychology and the science behind it, y'all. It's just like baking a cake. Once you have the recipe, you'll know how to make the cake taste good every single time. And so it's the same thing with your credit. Once you get your credit right and you understand the recipe, you'll be good to go and you'll know how to make that credit good every single time. So remember, y'all, credit is not just about having credit cards, paying back stuff that you can't pay for, buying stuff that you can't afford. It's not about that, y'all. It's about leverage. It's about getting access. Once you have good credit, you're able to walk a different terrain on this earth than other people that are walking the same earth as you, because some of us have a different access simply because we have better credit. Because when you have better credit, you have better leverage. When you have better leverage and better credit, you get better access. When you have better credit, leverage, and better access, you have a whole different life, y'all. Come on, y'all. Let's go to the never employed side, the graduate to never employed side, where we'll coach you and show you, one, how to fix and build your credit. If you're looking to start and build your own credit repair funding business, we'll show you how to do that. Or if you just need help getting your credit fixed and getting funding, then we can do that for you as well. But just understand that you have the mindset. If you just watched this entire video and heard me talk about what's important to get your credit score to an 800 plus. So I salute you. I'm praying for your success. And if you need help, just make sure you get access to the link below. Make sure you like and subscribe to this video. Subscribe to my channel, right? Because we're going to keep talking about how you can get to that next level in your life financially, y'all. If I was able to retire in my early 20s, I know you can retire early in whatever age that you're at. It's all about leverage. It's all about cash flow. It's about assets. It's about developing your mindset It's about developing the life that you really want to live. We're going to do it together, y'all. Make sure you tap in, lock in with me, and I'll see you in the next video. All right, we signing out.
Fat Daddy, baby.